Thanks for joining us today on The Close. I'm Marella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following in the BNN Bloomberg newsroom. U.S. President Donald Trump in China for a visit that was delayed by the conflict in Iran. He will meet the Chinese leader, Xi Jinping, tomorrow. It's the first visit to the country by an American president in almost a decade. Trump says his priority is to discuss trade and not the war in Iran. He has several tech executives with him on this trip, including Apple's Tim Cook and Elon Musk. The NVIDIA CEO, Jensen Huang, also joined at the last minute. Equinox is buying Orla Mining in a stock-based deal that values the miner at $5.1 billion U.S. The deal will give Equinox access to Orla's assets across the Americas, including its flagship mine in Mexico. Equinox shareholders will own 67% of the combined firm. Orla shareholders will own the remaining 33%. The Orla CEO, Jason Simpson, says they're hopeful that stakeholders will see the value in the deal.
We know that we've got the support of our major shareholders in this transaction, and we are hopeful that the remaining shareholders will also see the value in what we've created as a combination. They saw the value in what Orla had in our growth platform, but had to be patient with its delivery over the next 5 to 6 years. In this situation, they will not only get the assets they're familiar with at Orla, but get access to the great assets that Equinox has.
GoEasy shares under pressure today. The company reported a bigger loss than expected and adopted a shareholder rights plan to prevent hostile takeover bids. The subprime lender has been grappling with losses in auto lending and writing down hundreds of millions of dollars worth of debt. GoEasy says charge-offs will remain elevated next quarter and will remain in the mid-teens for the full year. The firm says it remains confident it can return to strong credit performance eventually. Here is where we are so far on the day, with the TSX Composite down 214 points, 0.6% to 34,078. Across the border, the U.S. markets, the S&P 500 gaining 53 points, or 0.7%. The Dow Jones down about 47 points, or 0.09%. And the Nasdaq moving up 350 points today, or 1.3%. Of course, the uncertainty brought by the war in Iran continues to weigh on the markets. But watching where the puck is going after the oil shock could result in some new opportunities. That's according to Sebastian McMahon. He's chief strategist and portfolio manager at IA Global Asset Management, and he joins us now. Sebastian, thanks for joining us today.
Yeah, good afternoon.
So where is the puck headed? What sector does it open up?
Well, historically, when we've seen oil shocks, we have typically seen food inflation follow. And the reason is simple. When you have shocks like these, in the Middle East, you have the production of nitrogen, which is a byproduct of the production of oil and gas. And also you have lots of phosphate that is being extracted there and shipped through the Strait of Hormuz. So far this year, we've seen the price of oil rise by about 50%. We've seen the price of fertilizers up also about 50%. So likely in the stories that we're hearing is that global farmers are saving a bit on the fertilizers, and that will lead at some point to some weaker crops. So looking forward, history tells us that it's not 100%, but still inflation on food could be coming up next. That could lead to some social unrest and some political issues for sure, but also brings investment opportunities, not so much within equities, but within the commodities themselves. So that would be where we'll be looking at going forward.
Okay, that being said, I know you've been looking at the charts, and agricultural commodities are not historically a good investment longer term. What is the difference this time?
Yeah, exactly. So this time is not different. It's not a buy and hold strategy. If you invest in agriculture, usually you don't want to stay there, because if you had put your money in agriculture in 2000, you would be down after 26 years, down 37.5%. But if you had invested in the stock market, you would be up over 700%. So there are some environments where agriculture makes a ton of sense, and environments like this, when you want to hedge inflation risk, risks when you want to buy the commodities that will be going up in prices and cause the inflation. It makes sense. So, ETFs like DBA could be an idea, but for us institutional investors, through some futures, there's ample opportunities across the commodity space.
We know, as you mentioned, that the fertilizer route is strained because of the Strait of Hormuz. Would you invest in fertilizer stocks right now because of shortages?
Well, I wish I had done that earlier, because if you look at the company like Nutrien, you did have lots of growth in the stock price in the month of March, but now markets are looking at weaker demand because prices are rising too much, and this is causing some demand destruction. So it used to be a good investment, let's say a month or two ago, but right now we think that the opportunity maybe has passed. But if you look at the commodity itself, if you want to buy the agriculture and the commodity, then we feel that there's lots of upside moving forward.
Okay, let's get to another big story of the day. Equinox Gold's acquisition of Orla Mining. Do you think we're going to see more deals in the sector?
Well, we could see some more deals, but this one is interesting. Usually the large players buy the smaller players to grow. So we've seen that in the past for sure. But this is, let's say, more akin to a merger of equals. And here you have two intermediate players that merge and that become a larger player. So that creates, something that is more relevant to investors. It does unlock value. So I was just listening. You showed the co-CEOs here discussing that, how the shareholders are behind this. So if you create a business that has a high quality deposits away from geopolitical risk, because it's mostly in the Americas, we could see some revaluation. So it makes a ton of sense in where we're still in a gold bull market. So that's a strategy that makes a ton of sense.
Okay, let's talk about Algoma Steel, which did report earnings. First quarter loss, not a surprise. Tariffs costed $27 million U.S. in the latest quarter. They're actually downsizing, of course, what they send to the U.S. because of the tariffs. But do you see more Canadian earnings perhaps getting impacted by tariffs? We don't talk about them very much anymore.
No, we've heard from the likes of BRP over the last month or two, and then today with Algoma. So the surprises likely they are behind us. We're just about to end earnings season here. We could still have some surprises in 2026 in the auto parts sector because it's just so dear to the White House. But even if we don't have some short-term surprises, make no mistake, here the headwinds are very strong. So the volatility of the trade regulation and the changes that we're seeing, the complexity of that is creating a very solid headwind. And there's many projects that we're hearing about that are delayed or canceled for investments, for hiring. So even if we don't have anything new in the next few months, the long-term damage seems to be very real for the Canadian economy.
We're seeing chip stocks, of course, go through the roof with Donald Trump and some of the tech executives now in China, although not sure what's expected out of that trip as far as investment goes. Why is tech, do you think, so untethered from everything else that's going on? Inflation, geopolitical problems, that kind of thing.
Yeah, when you look at the forecast for demand of tokens, so if we think that AI is going to take over the world, that means that there's going to be lots of demand for tokens. And, we're seeing lots of forecasts coming out these days. And we see that, we're going to be way behind in the construction of those data centers, even though we're hearing about hundreds of billions of dollars a year in investments. So what that means is that the price of token is going to be much higher. So that will delay AI adoption through the economy. So that's going to slow things down. But that also brings a lot of pricing power to those businesses. So that means that we will be in a world where you cannot build data centers quickly enough. So that's going to be the capex cycle that will be leading the economy for the next multiple years. And finally, likely, we're going to be seeing some results, some financial results coming from the hyperscalers and the owners of the data centers. So it's one of those themes where you want to stay involved, you want to stay invested for the long run. And whatever happens in this China trip here, this fundamental story is not going away.
Okay, let me get to your stock pick today, which is Whitecap Resources, which I think plays into the idea of tech and that build out. Tell me about it.
Yeah, it's more about our view on the energy sector and what's coming from the federal government. They're really behind this idea of making Canada an energy superpower with all of those pipeline projects that are being, green lighted, or at least they want to accelerate them. So, of course, Whitecap, one of the darlings from Calgary, they're a scale Canadian E&P compounder, $19 billion market cap. They're one of the top tier independent players out there. Number 7 oil producer and number 5 natural gas producer in Canada. Very high quality production mix. If you want to get some income, it's actually very competitive compared to Canadian banks with a 4.6% dividend, and they have excess free cash flow that can be directed to buybacks and dividend sustainability. And of course, with ARC being taken out by Shell recently, Whitecap becomes one of the few remaining large cap Canadian E&P. So it checks a lot of boxes: scale, liquids exposure, long inventory, disciplined capital returns, and a company that is very credible in keeping to just return cash to shareholders. So it's one of those titles, those names that make a ton of sense in the Canadian stock market.
Sebastian, I got to leave it there. So thanks for your time today.
Great pleasure. Thank you.
Up next, U.S. President arriving in China. Trade talks expected to be high on his agenda. Back in a moment. The U.S. President Donald Trump arriving in China today for a critical summit. He's going to try and focus on trade as he meets with the leader there, President Xi, looking to get China to buy more American goods. But the war with Iran is looming over that meeting. ABC's Lionel Moise reports.
President Trump seen here arriving in Beijing this morning for his high-stakes summit with President Xi Jinping as Americans are dealing with skyrocketing prices here at home. Tech CEOs Elon Musk, Tim Cook, and others are among the business leaders on the trip. Everything from tariffs to AI will be on the table. But overshadowing the summit, the war in Iran.
We're going to have a long talk about it.
China buys more Iranian oil than any other country. Trump is expected to urge Xi to pressure Iran into reopening the Strait of Hormuz. The question will be, what does Xi want in return? Before leaving for China, President Trump said higher prices here will not influence negotiations.
The only thing that matters when I'm talking about Iran, they can't have a nuclear weapon. I don't think about Americans' financial situation. I don't think about anybody.
The comments drew immediate criticism from Democrats and come as families are feeling the pain from the biggest jump in the cost of living in 3 years. Inflation rose last month by 3.8% compared to the same period last year. Energy prices fueling the surge, with gas up 28.4%. Airfare is up more than 20%. Beef at an all-time high, up 14.9%. Ground beef now more than $7 a pound. Tomatoes up 50%. Coffee up nearly 30%. The high costs also driving up prices in restaurants.
All the lettuces, whether it be iceberg, romaine, field greens, they are high. Oranges are high. Tomatoes are almost over 4 times what they normally cost.
By one estimate, households are spending $642 more per month for the same items compared to 3 years ago. Another factor impacting families: for the first time in 3 years, wages aren't rising faster than inflation. President Trump has said he will be talking with Xi about trade more than anything else. Lionel Moise, ABC News, New York.
All right, let's bring in Jeremy Chan on this discussion, senior analyst for China and Northeast Asia team at Eurasia Group. Thanks for joining us today.
Thanks for having me.
So this is a fairly quick meeting. Do you expect any big takeaways?
I think that we're going to see a meeting that is long on substance and optics and short on actual outcomes. It's important to stress that this is the first of what is up to 4 meetings between the two leaders in calendar year 2026. And so we're expecting that what they're trying to do is sort of feel each other out, stabilize the relationship, and sort of punt on more meaningful and thorny deliverables until later in 2026.
Tech and AI clearly will be some sort of focus. You've got the key CEOs there with Donald Trump. Do you expect any new deals to get announced?
I think the deals are mostly going to surround purchase agreements. So, China committing to buy more U.S. agriculture, aircraft, energy exports, et cetera. Maybe a little bit around tech as well. Obviously, some speculation about what may be coming vis-a-vis NVIDIA chips, for example. But I think we're a little bit less clear about whether China is willing to commit to buy, for example, the H200s without securing further commitments from the U.S. to relax restrictions on tech exports.
As you know, NVIDIA CEO sort of joined at the last minute, met the team in Alaska, and went from there.
Right.
NVIDIA stock is at an all-time high today, 227 last time I looked. Why do you think that this was a last-minute ad, considering how close the NVIDIA CEO has been with Donald Trump in the past, and considering they're at the forefront of chips?
That's a good question. I mean, we picked up on a little bit of friction lately in the Trump Jensen Huang relationship compared to at least the halcyon days of the first 6 months of the Trump administration. And so I wouldn't necessarily overinterpret the closeness of their relationship. We don't really have a good sense of why exactly the Alaska rendezvous happened, beyond that it made for great theater and was highly dramatic. But obviously, Jensen has a lot of business to do in China, and it's really about getting both President Trump and President Xi to come to the table and to agree that NVIDIA chips should be flowing in greater numbers to China.
China, of course, buys a lot of Iranian oil. Do you think this touchy topic is going to get addressed? Could Trump look for Beijing's support some way with Tehran?
I think it'll absolutely get addressed in some capacity. I think that Trump and Washington broadly overstate or overinterpret how much influence China really has over Iran, and certainly how much influence China is willing to use against Iran. And so I think purchase of Iranian oil by China will come up, potentially in the context of U.S. sanctions against the Chinese sort of independent refiners and the banks that support them that are receiving this Iranian oil. But I don't think that we're going to see a substantial reduction in Iranian oil flows to China one way or the other.
That being said, China still faces American tariffs. So do you see that easing at all?
U.S. tariffs against China have come down substantially since the Supreme Court ruling in January. They're down a nominal 20% from where they were previous to that. Meanwhile, China's tariffs against the United States, which are always placed on a reciprocal basis, haven't budged whatsoever. I think Beijing is looking for greater clarity from where long-term U.S. rates vis-a-vis China end up after the ongoing 301 investigation concludes, likely by the end of July. So I think tariffs will be discussed, but I don't think we'll get a ton of clarity about where long-term rates end after this particular summit.
All right, let's get to another touchy topic for both sides, arming Taiwan. We know that there is an agreement to supply from the U.S. to Taiwan. Do you see a change in that, perhaps smaller shipments getting sent to Taiwan from the U.S., perhaps some other pivot from Washington because of pressure from Beijing?
So Beijing was enraged at the record high sale that was announced in December, and they made it very clear to Trump and his team that this summit would only happen on the precondition that there are no other arms packages were announced prior to it. With that said, Congress has authorized a $14 billion arms shipment. And so I think the ask from Beijing to Trump is to at least delay, if not reduce, future U.S. shipments of arms or sales to Taiwan. I think that will be a topic of discussion. I think there's a lot of questions around whether Trump will agree to that or not. And I don't think we'll necessarily get a firm commitment one way or the other coming out of the summit.
How much capitulation can Donald Trump do, considering the situation he is in with Iran, considering he has midterms this year, and Americans are already pretty upset about higher prices?
No, I think Trump and his second administration have learned that the Taiwan issue is the most sensitive and the most neuralgic in the U.S.-China relationship. And so I think he'll be very clear or very, very cautious about making any firm commitments one way or the other on Taiwan. With that said, I think that if he's 10 out of 10 in terms of his priority vis-a-vis ending the war with Iran, then Taiwan for him is a 4 or 5 out of 10. And so there is always the potential for a surprise concession by Trump, just given that asymmetrical sort of interest.
All right, Jeremy Chan, I'll leave it there with you, sir. Thanks for joining us. Jeremy is a senior analyst, China and Northeast Asia team at Eurasia Group. Ottawa is close to striking an industrial carbon pricing deal with Alberta. We'll bring you that story when we come back. Alberta and the federal government are close to finalizing a new accord on industrial carbon pricing. Let's go to Bloomberg's Brian Platt. He joins us with more details. Brian, this has been a big obstacle between the federal and Alberta's provincial government for years. What have you learned about the details?
Well, they seem to be ready to sign a piece of paper, which they've been hotly debating over the past few weeks, especially, but really since last fall when they signed this broader energy pact on the carbon price and where the industrial carbon price is going to go from here. So this is only the carbon price that applies to the heaviest emitters in the province, and in particular the big oil producers. And the general idea here is the carbon price that these producers will have to pay is going to hit $130 per ton, and that is the price they will actually have to pay, not just the headline price, but the actual sort of trading price of these credits, but not until 2040. And so I think that was the big concession the federal government gave here. It's going to take more time to get to this price level, which gives oil producers a little more breathing room, especially over, say, the next 5 years or so, because originally people had thought this price might get there by 2030. So essentially there's an extra 10 years to work with.
Okay, can you remind us about the disconnect between the two historically, why Alberta was never on board with the pricing that was laid out by Ottawa in previous years?
Yeah, so this gets a little bit tricky because you've got the headline carbon price, which is what lots of people talk about, but then there's something called the effective price or the actual trading price. And the carbon market in Alberta, and I think you'll hear this from Mark Carney's government a lot over the next 2 days as we get to this actual agreement, the carbon market was malfunctioning. It wasn't working. The carbon price in Alberta right now is at $95, but those credits trade far below that. Right now, I think that the price today was only at $40. So that's $55 below what the headline price is. And so the key part of this agreement is that it's not just the headline carbon price we're talking about, it's the actual, what's called the effective price, how much those credits will actually trade for. And that's going to be $130, but not until 2040. Yeah. And just to quickly say, the reason why this really matters is because in order for Alberta to have a pipeline, the federal government says you've got to build a carbon capture system. That's that big pathway system. And the carbon price, the carbon market is how you generate revenue for the carbon capture system. The whole deal kind of hinged on them coming to an agreement on this carbon price.
Okay, so let's talk about when we could see some details as far as the pipeline goes. Do you expect that to be around the corner?
Yeah, the Alberta government's going to unveil its pipeline proposal, or at least a few options for a pipeline in June. And then the way this works is that the Alberta government will make an application or a submission to the federal major projects office. And that's when you start to really get into the nitty-gritty of, okay, here's a couple of possibilities for the route that a pipeline could take through the Rocky Mountains and to the Pacific Ocean. And so that's when we'll really get into it, is next month.
Bloomberg's Brian Platt with the latest out of Alberta. Thanks for that update. Appreciate it. Coming up next, the closing bells on Bay Street and Wall Street. Back in a moment. Here are the closing bells for the end of the trading day at the Nasdaq today. Public Policy Holding Company ringing the bell. In New York, Roland's ringing the closing bell. And in Toronto, the LGBTQ plus Corporate Directors Canada Association with the honor. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX ending the day down almost 250 points, or 0.7% today. Let's get to the S&P, which hit a new record high. It was last hitting a record close on Monday. Today it moved up 43 points, or almost 0.6%, taking the new record close to 7,444. The Nasdaq, also a record high. It's been making a lot of records lately. The latest record close was on Monday as well. It's up 1.2% from yesterday, so it's 26,402. That's a 314-point move on the day. Let's get to the movers in Toronto. I'm going to start here with Finning International, the world's largest Caterpillar dealer, said equipment backlog reached a record $3.8 billion at the end of March. That took the stock up 8.7% today to 104.97. Let's get to some mining stocks, which are also on the move today. Abra Silver up 7.5%. Capstone Copper up close to 5%, 4.93%. And Lundin Mining up 3.4% today. On the flip side, we have Boyd Group dropping close to 12% or $18.32 a share, down on first quarter earnings. More on that with Stephanie Hughes in just a moment. Thomson Reuters, which has been eaten up by concerns about software, also dropping today close to 7%, close to 5.9%, so $6.98 down per share to $112.62. Having a look at Stantec as well, it's down 6.4%, down 18% over the last year. Stock price down to $106.92. That's a drop of $7.33 a share. Let's go to Bloomberg's equities reporter, Stephanie Hughes. She joins us now to talk some more about the movers. Stephanie, let's start with GoEasy. They had an earnings miss. What metric did they miss on?
Yeah, that's right, Morella. So GoEasy is having a rough go of things still. Those shares dropped by over 7% at their lowest point, which made it one of the worst performers on the TSX for a good chunk of the trading day today. And also, that was enough of a plunge to bring the share price to its lowest level since March 2020. So it's been a while since we've seen the stock at that level. So the subprime lenders' adjusted loss of $1.90 per share was actually deeper than what analysts were expecting. That and the nearly 18% in net charge-offs were about double where they were at last year, but still within the range of what the company laid out back in March during the previous reporting season. GoEasy also launched a shareholders' rights plan to thwart any takeover bids after a rough year for the firm so far. The shares are down about 80% last time I checked on a year-to-date basis. So this plan would give the board more time to carefully consider unsolicited bids, and that plan was conditionally accepted by the TSX. So the analyst reactions to all of this were pretty interesting, starting with John Aiken over at Jefferies. He said that the results were far from disastrous, even though there was a miss and the second quarter guidance was tepid. But he did add that the GoEasy is weathering the dual storms of running down its LendCare portfolio and just contending with this weakening economic outlook. So it's a pretty interesting commentary coming from his shop. BMO's Etienne Ricard said that with many of these questions outstanding, his team just has no confidence in the earnings forecast. So it seems like the path forward for GoEasy is still a little uncertain in what's already been a complicated year, Morella. Okay, let's get to Boyd Group. It has also seen a deep fall in share price more recently and reported earnings. So what did we learn? Yeah, deep fall is a great way to put it. Yeah, those shares plunged by as much as 15%, dragging the stock down to its lowest level since 2022. That's because the company, which operates collision repair shops, reported some weaker same-store sales for the first quarter, which fell short of what analysts were hoping to see. And despite the miss and despite the dramatic share price reaction, the team at Stifel said it was generally a solid quarter for Boyd Group, and that it was nice to see an EBITDA beat and an earnings per share beat. So the analyst at that firm, Daryl Young, said or did add that the same-store sales growth recovery has been stubbornly slow, to use his words, and has also been a clear focus for investors. So that's what's giving us this double-digit share price drop today. So Boyd has been having a challenging couple of weeks, challenging year so far, with the shares falling by over 38%, mostly in the last few weeks. And moves like today that we're seeing are just kind of adding to that sell-off, Morella.
All right, we will leave it there. We have Bloomberg's Stephanie Hughes, the latest in Toronto. Let's get to movers in south of the border in New York. Bloomberg's Avalon Purnell joins us now for that. Avalon, Ford has a new business. Tell me about Ford Energy.
Absolutely. Ford was up more than 13% into the close today for its best one-day jump since 2020. That's after Morgan Stanley issued a really bullish note today saying that they could imagine that the automaker's energy storage business could reach and potentially make a deal with hyperscalers, which have been really intertwined with the AI surge in interest earlier. And what's kind of important here is that the analyst said that investors are potentially overlooking the potential of this segment to drive better profitability within Ford's electric car segment. The analyst said that he sees a fairly high likelihood that Ford is going to sign a supply agreement and that this segment could be worth even up to $10 billion. Worth noting that Ford CEO also said that the energy storage business is a key element to reaching the company's goals.
Wow. Okay, so it could be a big part of the business down the line. Let's get to more strength in semiconductor stocks today. They didn't need any more strength. They definitely got it. Is this on the trip to China?
Oh, yes, it's definitely on the trip to China. So ON Semiconductor was one of the biggest gainers on the S&P 500 today, leaping 11% to lead its sector higher today as global supply of memory chips continues to remain strictly tight. And the sector is also getting a boost after NVIDIA CEO Jensen Huang joined President Donald Trump on his visit to China. That last-minute addition has pushed a lot of those shares of chip makers, opticals, and also photonics firms like Micron and Qualcomm up higher as well. Worth noting that rare minerals are a crucial component for developing memory, and as the AI craze continues, that has led to a very much surged price for these memory cards as well. So will definitely be something we'll keep an eye on.
Yeah, definitely a shortage to watch. Bloomberg's Avalon Purnell, thanks for the update. Up next, mixed markets and stock picks in healthcare and energy. Back in a moment. Stocks are mixed today, swayed by higher U.S. inflation on one side and then the tech rally powering ahead on the other. And Kevin Warsh has now been confirmed by the U.S. Senate as the next chair of the Federal Reserve. Let's go to Sam Stovall on this. He's Chief Investment Strategist, CFRA Research. Thanks for joining us today.
Happy to be here, Marella.
We have that higher CPI report for April wholesale inflation today, both higher than what was expected. What does Kevin Warsh do with this now that he's been confirmed?
Well, I think Kevin Warsh will have to, first off, move to a neutral stance from an easing bias. I think certainly he will be looking at the data and concluding that right now there's no evidence to be required to cut interest rates, although right now the market does not see the Fed raising rates by year end, that the likelihood is to be in the first quarter of 2027, but certainly not this year.
Okay, let's talk about the Strait of Hormuz, closed still. Do you think the higher oil prices will impact earnings in the next quarter? We really didn't see them have much effect so far.
No, we didn't seem to have much effect. Actually, Q1 results are now twice as strong as was anticipated on March 31st, meaning up 25% versus the 12.5% anticipated. We did see a 1 percentage point improvement in Q2 estimates, with 3 sectors posting the greatest increases, those being energy, materials, and tech. And for all of 2026, we saw 5 percentage point improvement in estimates. So it seems as if Wall Street does not expect much of a drag from energy, even though the old adage was that for every $10 increase in the price of oil on a prolonged basis would take away anywhere from 10 to 20 basis points of real GDP growth.
Okay, so I'm sure at some point it's got to bleed through to some of those companies that rely on energy and have to pay for it in a consistent way. But tech just seems to escape everything. Do you expect that to continue despite the big amount of energy they need for their build out?
Well, the tech just seems to be running on an engine of its own. Certainly with the data centers, they themselves would require the power to run them from the utilities from which they're drawing the power. So I think that we have to see some sort of a drag come onto earnings, not only in your more traditional economically sensitive areas like industrials, but also in consumer staples, from packaging, from transportation, et cetera. So I don't think that we are going to get away from this altogether, but I do believe that it is likely to be delayed into the second quarter, and guidance for third quarter and beyond could end up pressuring stocks.
Tech, of course, has been a pretty contentious topic between the U.S. and China. Donald Trump now in China. He's taken some of the tech executives with him there. Do you think that there will be something coming out of this meeting that is solid that could affect the sector either way?
Well, our tech sector group head, Angelo Zeno, is not expecting much to come out of it. The big concern is that there are no misstatements that are made that could create even bigger problems. But at the same time, when you do bring along an entourage of executives from the high-profile tech area, you do hope that something positive will come out of it, not just a show of celebrities. So I would tend to think that at least some sort of positive statements about tech, maybe no negative statements about Taiwan, and the possibility of some support regarding opening up the Strait of Hormuz could come at it, but I'm not expecting a lot.
Yeah, it's so interesting that he stacked the visit with these kinds of executives, but a lot of people I've been talking to say, yeah, they don't expect much as far as deliverables in tech. Let's get to stocks that you like right now in a period that remains volatile. You like West Pharma Services. Tell me about them.
Yes, well, this obviously is a pharmaceuticals firm that does have a lot of exposure to what they call high-value products, in particular biologic business. They are also seeing growing market for their GLP-1 syringes. Also, what we find is that in midterm election years, during the May through October sell in May period, healthcare has outperformed the S&P 500 100% of the time, meaning 9 for 9 times, going back to 1990. So possibly if we do end up seeing more volatility in the market, investors will be gravitating toward the more defensive areas such as healthcare.
Okay, you also like American refiner Valero Energy. They are up over the past year. Is it able to protect its margins with everything else going on?
Well, we think it will. It has a very strong position in the Gulf Coast area. About 65% of its refining capacity comes from the Gulf Coast, has relatively low debt, and at the same time, very strong return on capital. So it is our favorite in the space.
Okay, you also like the American Assets Real Estate Investment Trust. Why is that?
Well, here's a company that was identified by our Lowry technical analysis arm. It's a full-service, vertically integrated, self-administered real estate investment trust. It's paying a hefty 6.5% dividend yield, and it is showing an improvement in terms of the proprietary power ratings as well as the overall price trend.
Wondering if you expect volatility to carry on. We know there was much more volatility at the start of the conflict in Iran. Some of that has tempered off a little bit, but I'm just wondering what you see ahead.
Well, history would say yes, that actually the midterm election years are by far the worst. Average drawdown being 18%. The second and third quarters do tend to be the most challenging, with frequency of advance at less than 50%. So the concern is that right now, when we're looking at the S&P high beta outperforming the S&P low volatility index on a relative basis, the highest since inception more than 10 years ago, you do sort of wonder whether we are due for some sort of digestion of gains. So I don't think that volatility has been ruled out. Usually we find that the peak tends to occur in the mid-June to mid-July timeframe.
Okay, and that is near at hand. We will leave it there. Thanks very much for joining us, Sam Stovall, Chief Investment Strategist, CFRA Research. Coming up, Equinox Gold buying Orla Mining, a cash and stock deal valued at over $5 billion U.S. We got more from the CEOs in just a moment. Equinox Gold is buying Orla Mining in a cash and stock deal valued at $5.1 billion U.S. The combined company expected to produce about 1.1 million ounces of gold annually. For more, we sat down with Darren Hall, who's CEO and director of Equinox Gold, and Jason Simpson, president and CEO, Orla Mining.
This at-market combination, it's a zero cash deal, it's an all-share deal, provides a really unique opportunity for both sets of shareholders as we see both companies ramping up production to be able to come together. We get a very symmetrical deal going forward. Both sets of shareholders will benefit from the growth that Equinox brings, Orla brings, and together we accelerate into being a senior producer much more quickly than what we would have done as a part. So that's the value proposition in a nutshell.
And when we're talking about gold production, the combined company is expected to produce 1.1 million ounces of gold annually, but you see a clear path to 1.9 million ounces. So, Mr. Simpson, maybe you want to take this one. Can you tell us about your strategy for reaching that goal and maybe a timeline as well?
Yeah, certainly. Both companies, Equinox and Orla, had growth platforms built into our individual companies. And as Darren characterized, what this combination does is it enables us to accelerate that transition into an over million ounce a year producer and then begin the growth through our combined portfolio in sequence to get us that 1.9 million ounces. And so we have clear visibility on the sequencing of those growth projects that'll propel us towards 2 million ounces and all the while operating our 6 assets to produce the first 1.1 million ounces beginning this year.
From a shareholder perspective today, though, I mean, looking at this merger, why is this better than staying as 2 separate companies, especially for Orla investors who may feel that they're being diluted? Mr. Hall?
Yeah, maybe I'll pass it to Jason to answer from the Orla perspective.
Yeah, our perspective on this is we see a greater value proposition in the combined company, not only the immediate platform that we have becoming a senior gold producer and the second largest producer of Canadian gold, but also the growth that Darren and I will unpack in the coming years, starting in Newfoundland, then in Nevada, followed by California and the other assets in our portfolio. And so the growth and value creation proposition of the combined company far exceeds any conversation about today's premium. We know that we've got the support of our major shareholders in this transaction, and we are hopeful that the remaining shareholders will also see the value in what we've created as a combination. They saw the value in what Orla had in our growth platform, but had to be patient with its delivery over the next 5 to 6 years. In this situation, they will not only get the assets they're familiar with at Orla, but get access to the great assets that Equinox has. And all of that creates a value pathway on a much more accelerated basis and amplifies the potential value creation we can deliver to both sets of shareholders.
And if there's one thing I can add to that, it'll be that, we're not increasing the jurisdictional complexity associated with this transaction. We're operating in the same place as we are today. We're putting these things together so that the opportunities that'll exist to be able to leverage off the strengths that we both have in those regions will be significant and will further add to the value that we can surface from this transaction.
This is probably a question for the Orla side as well. Did you look for any other offers before this deal?
I would offer that we are very plugged into to the entire mining scene and consider things frequently. And then when we became focused on this transaction, we of course spent a number of months making sure that we did significant due diligence. And so I would offer that we're all aware of each other. Darren and I know each other and have looked across the market at each other's growth. And I'm pretty impressed with what Darren has done through Calibre and now Equinox. And I expect he's equally satisfied with what I've done at Orla. And so it just seemed to be a very natural fit, as Darren described. The geographic symmetry of our independent companies makes for a very straightforward story and limited geographic complexity in the combined company. And then finally, both of our teams will be able to merge and deliver the production and growth that Darren and I have talked about.
Both Orla and Equinox based out of Vancouver, so 2 Canadian companies. Was it important to you both that this is an all-Canadian combination rather than a foreign takeover?
No, I think that, again, the value proposition as we've outlined is clear. The benefit from this transaction is the synergies we've discussed and the symmetry that we've discussed. But, we come out of the gate here as the second largest producer of Canadian gold, with a great profile to increase that base as well as we continue development of our North American platform. And we look forward to the future of being, north of 70% of our mining NAV coming out of the US and Canada. So, positions us really, really well.
But the fact that you're an all-Canadian combination, right, when we're seeing so many Canadian companies being taken over with foreign ownership, that wasn't important at all?
It's a consideration, of course. But, again, we're proudly Canadian. But our first responsibility is that we're a financial instrument to create shareholder value. And we do that through share price appreciation, and we see as a clear pathway to do that. And leveraging off our Canadian base is a critical component of that, for sure.
Okay. Mr. Simpson, I'm not sure if you want to take this next one. Post-merger, depending on how long this takes, how does your asset mix change in terms of jurisdiction risk, mine life, cost profile, all of those factors?
Yeah, so let's speak first about some of the timing that you questioned. We anticipate closing this transaction in the third quarter, so that's the timeline people should anticipate with the necessary regulatory and court approvals, and at which point we'll be combined. And what changes is that we have a larger platform, but really in the same jurisdictions. As I described, we now have multiple mines in Ontario, one in Newfoundland, so that Canadian platform anchors with those three great assets. And to the mine life question you spoke about, the Equinox mines in Canada are just getting ramped up and have very long mine life. And then the combined company has resources not only in Canada, but the United States and Mexico and our other jurisdiction, Nicaragua, to over 23 million ounces of reserves that we'll be able to access and create further value. So everything is an improvement in the combined company, mine life, free cash flow, growth profile, and an instantaneous production of over 1 million ounces. And yes, we are clearly a North American-focused gold senior company now. Okay,
so and as you say, this deal expected to close in the third quarter. I believe it does require Mexican competition authorization as well. Correct me if I'm wrong on that, but how confident are you that timeline will be met? And is there a contingency plan in place if the approval is delayed?
Now, we don't see a significant risk in attaining the required approvals and closing here successfully in Q3.
Darren Hall, the CEO, Director of Equinox Gold. Jason Simpson, President, CEO, Orla Mining. Up next, a jump in profit for a mortgage investment company. The CEO of McCann Financial joins us after the break. Here are the stories we are following today. The U.S. president is in China, a visit that was delayed by the conflict in Iran. He will meet the Chinese leader Xi Jinping tomorrow. It is the first visit to the country by an American president in about a decade. Donald Trump says his priority is to discuss trade and not the war in Iran. He has several tech executives with him on the trip, including Apple's Tim Cook and Elon Musk. The NVIDIA CEO Jensen Huang also joined at the last minute. Shares of Finning International got a boost today. That's after the equipment dealer posted profit in its latest quarter that beat estimates and also saw a surge in equipment rental revenue. Finning says the results were driven by higher construction activity and product demand in Canada. New equipment sales in Canada were also up 23% from the year before. Algoma Steel posted a first quarter loss of close to $160 million, along with a drop in revenue compared to the year before. The Ontario-based steelmaker says it incurred more than $27 million in direct tariff costs during the quarter. Algoma attributes these changes to its transition away from blast furnace operations to its new electric arc furnace platform. McCann Financial is a mortgage investment corporation. It reported a 39% jump in net income for the first quarter. That was driven by higher new mortgages and rising income from its stake in mortgage finance company MCAP. Joining me now is Derek Sutherland, President and CEO of McCann Financial Group. Thanks for joining us today.
Thanks for having me, Marilla.
So you provide residential mortgages, but also commercial mortgages, investment. Which is the biggest part of your business?
The biggest part of our business is the residential mortgages and growing as we gain more and more traction in the mortgage broker market.
Okay, how is your structure different from others?
We're structured as a mortgage investment corporation, which allows us to distribute all of our income tax-free to our shareholders. But we're also the only mortgage investment corporation that's regulated by OSFI and accepting CDIC insured deposits.
Okay. What led to the higher mortgages for the first quarter? Insured were up over 120%, I believe.
It's been a good market for MCAN because we stick to our knitting. What we've been doing since 1992 is focused on residential mortgages, and the consistency and resilience of our platform drives the confidence in our business partners, whether they be mortgage brokers or originators and servicers on the construction side. And they have confidence in us to get the deal done that they bring their clients towards.
Okay, so can you explain how loan securitization works? I know it's key for your bottom line.
As a mortgage investment corporation, or MIC, we're able to access, and a regulated entity, we're allowed to access the securitization market, whether it be the CMHC programs for insured mortgages or the conduit programs sponsored by the banks for our uninsured mortgages. But those are funded off of our MIC balance sheet, so we don't need that much capital allocated towards those assets, which drives results down to our bottom line.
Okay, let's talk about loan loss provisions. I know a number of the banks last year were putting more money aside for that kind of thing. What are you doing as far as loan loss provisions go now?
We're continuing to increase our provisioning. Yes, it's down from what we provided for last year. We took a lot of provisions in 2025 to the tune of $11 million, of which we only had $1 million of actual write-offs. So we further increased it in Q1 based on growth of the portfolio.
What are you expecting for the rest of the year? We are seeing delinquencies growing.
Delinquencies are growing, Marilla, but the resilience of the Canadian borrowers is really amazing. The psyche is to stay in their homes and not lose them. So they always find ways to make their payments. And we always work with them to make sure they stay in their homes.
As you know, Derek, they're facing a lot of change with the energy prices that are going up and no end in sight. To that, groceries have been going up steadily for quite some time. There are different challenges the Canadian consumer faces now that they didn't face even 2 years ago, 18 months ago, and some of them have to renew mortgages at higher rates. Do you feel more confident or just as confident with all those scenarios moving forward?
Yes, I do. Considering most of the mortgages that we have on our balance sheet are uninsured, and they've really renewed over the last year or so. The average term of our book is probably 18 months. So they've already renewed, and they're actually renewing now at lower prices, lower interest rates than they were before.
So what is your focus for the future?
Our focus continues to do what we do, which is steadily grow our balance sheet, providing greater returns to our shareholders, and steadily increasing our dividend for our shareholders.
Is there a goal in sight for dividend?
Just to prudently grow it so that it's a strong, steady growth and return for our shareholders.
Got it. Derek Sutherland, appreciate you joining us today. Thanks for your time.
Thank you, Marilla. I appreciate it.
Up next, new venture capital for Canadian growth companies has virtually dried up. What's gone wrong and can it bounce back? More in a moment. The Canadian Venture Capital and Private Equity Association says new venture capital investment is down, specifically for growth stage companies. Let's talk to Benjamin Bergen on this. He's CEO of Canadian Venture Capital and Private Equity Association. Thanks for joining us today.
Thanks so much for having me.
First, let's explain what the growth stage is for viewers, if you don't mind.
Yeah, so these are typically firms that have already found scale and now are really looking to sort of grow. And so typically these are companies that are looking to raise sort of more than their Series B and are really sort of in the kind of 20 million in recurring revenue side of things and growing.
Okay, how much has that investment dropped this year?
Yeah, so what the data is showing is that we've had about $1 billion invested in Q1 so far, and the majority of that has been towards basically fewer deals, but larger envelopes of money. So as an example, we've seen 104 venture capital deals done this year, which is, the lowest quarter of Q1 we've seen since 2017. But what we have seen is larger dollar amounts. And this is actually consistent with what we're seeing globally. But as it relates specifically to growth stage companies, what we're seeing is that Canada continues to be a strong market in comparison to other economies as it relates to earlier stage support of companies. But it is in the later stage, in the growth stage, where we're seeing really a flatlining of domestic capital in terms of supporting it. And why that should matter to Canadians is that it really is in the ownership of these scaling firms that ultimately we're able to generate wealth and prosperity as a country. So for the companies themselves, they're often able to access capital from, let's say, south of the border in the United States. But by them not being able to attract and get domestic capital, ultimately what's happening to the Canadian economy is we're seeing the upside go south of the border.
Okay, so what does that tell you about where we are as compared to where the U.S. is if there isn't that domestic investment at that stage?
Yeah, and so the position that we obviously take at CVCA is that we actually have a domestic capital deployment problem. And so there is tremendous amounts of capital actually in our economy, but are we deploying it to growth companies? And the data shows that we're not. And so ultimately what we're seeing is that U.S. investors are making bets on Canadian firms. And so the policy objective then should be, how do we crowd in more domestic growth capital in order to support these firms from not having to, let's say, relocate to the U.S. or sell to Americans, and keep more of the upside here in Canada. And the sort of exciting piece, I would say, is that right now we have many companies over the last 10, 15 years, which we've nurtured through various government programs, through various supports in the seed, pre-seed stage that are now growing. And so, a report came out in the Globe and Mail a couple of weeks ago indicating that there was over 100 firms that had more than 100 million in recurring revenue. And so it's really those firms that are going and accessing growth capital. And if it's ultimately coming from the U.S., the upside goes south of the border. And so as we think about how wealth and prosperity and sovereignty are now intertwined, it's making sure that we're figuring out how do we support the capacity of those firms to be able to stay here, grow here, and at the end of the day, create a strong economy for Canadians to pay for the things that we care about.
So let me ask you two questions. A, let me turn it back on to you. How do we do that? And B, if there's a lot of foreign capital, particularly U.S. investment in these companies, is there a tendency or a reason to believe they might at one point move to the U.S.?
Yeah, so on the how to do it phase, I mean, really at the end of the day, it's about how do you create superior returns, and that's by having stronger companies. And so what are the tools that we have within our policy tool shop to do that? So that's things like government supporting procurement, that's tax competitiveness. One of the things we're calling for at CVCA is a Royal Commission on Tax Competitiveness. We haven't had one since the 1970s. And if you look at a lot of our tax policy, it's a little bit like sometimes we have the air conditioner and the heater on at the same time, and you wonder why we're not getting good outcomes. A lot of our tax policies really need to be, updated. So that's some maneuvering that we can do at the federal and provincial level to make capital formation easier. In terms of what we see with U.S. capital and the movement of offices and the upside, yes. I mean, short answer is that is what we're seeing. And so, how do we incentivize capital formation at this later growth stage? And typically we've done that through some incentives like VCAP or VGCCI, which the government is currently deciding right now, and using policy tools to ultimately crowd in private capital.
Okay, so I did want to ask you, as you mentioned, tax is a problem, and we hear this a lot from businesses and small businesses particularly. Has Ottawa been open to that? Have those conversations happened where you see an interest in changing some of the law around taxation?
So short answer is yes. I think this government is seized with a real sense of how do we create prosperity opportunities for Canadians, and realizing that tax is a big portion of that. And so, many of my trips to Ottawa have now actually revolved around what are the right measures that we need in order to grow the economy and help support the firms that CBCA members invest in. I mean, the sort of crisis we find ourselves in economically is one that really will only be solved when we increase the value of the basket of goods that we export globally. So in sort of layman's term, what I'm trying to communicate is that we have to have the companies of the future that get high value returns in order for us to continue to have the quality of life that we care about. And I think it's good, obviously, that the government is moving and looking at how to get more resources out to various markets. But at the end of the day, it will be high quality technology goods that ultimately will deliver the level of prosperity that we as Canadians are accustomed to.
Benjamin Birkin, got to leave it there. So thanks for your time.
Thanks so much for having me.
Coming up, we'll bring you a conversation with the CEO of Boston Pizza. That's next. Shares of Boston Pizza in the green today after the restaurant chain saw growth in the first quarter sales. We discussed the company's performance with Jordan Holm, president of Boston Pizza International.
But we were really pleased to see the strength in the first quarter of 2026, particularly because of the comparable period 1 year ago, which was also strong. We've had now 6 quarters of sustained top-line growth, really driven by more guests coming into our restaurants. There's a little bit of menu inflation in there, but it's the smaller part of the growth story. It really is attracting more people into lunch, late night, takeout and delivery, maximizing the impact of sporting events. So those are some of the levers that we're pulling on, and really trying to overcome what is a cautious, household and discretionary spending environment out there today.
I want to talk about that in a moment, but I guess when you're talking about sporting events, this would have included the Winter Olympics, right? So it was that kind of maybe a bit of the driver behind what you saw in the latest quarter?
It was certainly a help. Just like in the fourth quarter of last year, we had a contribution from the somewhat unexpected Blue Jays run all the way to Game 7 of the World Series. We saw a lot of people coming in right across the country to celebrate the Blue Jays at Boston Pizza restaurants across the country. So sporting events definitely contribute. The Winter Olympics is an interesting one because not all of the events attract people to come out and watch. The time zone isn't always complimentary, I'll say, but we did have about 2/3 of the 370 restaurants across the country that chose to open at, I was in BC at the time, and we were there at 5:15 a.m. puck drop. So we had a bunch of our restaurants open up and take advantage of that gold medal game. Didn't end the way we wanted, but it was definitely another opportunity to bring people in.
Yes, I forgot about that, how early those games were, particularly if you're at West.
Correct.
When you're looking at takeout and delivery orders, that seems to have played a big role in boosting sales in the latest quarter. Do you see that trend continuing?
I do. It's been a real sales contributor for full-service restaurants in general over the last 10, even 15 years. We've seen consumers want to bring more takeout and delivery into their homes or to do out-of-home catered events. And Boston Pizza has a long history, over 50 years of participating in takeout and delivery. And in the last 10 years, we've been participating now with the delivery service companies, so Skip, DoorDash, and Uber. And that's another way for guests to select Boston Pizza for in-home occasions or out-of-restaurant occasions. But still today, 75% of our sales are on-premise in our restaurants, our sports bars, and our patios. And that's really a focus is bringing people into the restaurants, not just the takeout and delivery growth.
How do you continue to do that, bring people into the restaurants rather than just have people take food out?
It's not easy. I mentioned the economic backdrop. People are feeling the pressures of inflation and having less discretionary spending. So you have to really focus on providing great value, service, atmosphere, of course, food and beverage. We do 5 feature menus throughout the year to give people different reasons to come in for culinary and beverage. We also maximize sporting events. FIFA is something we're very excited about just around the corner, which will bring people out, fans of all nationalities cheering on their national teams and people getting into the sport of soccer in a way that North America perhaps hasn't seen before. So it really is a day in and day out commitment to creating occasions that bring people off of their couches where they're very comfortable and into Boston Pizza restaurants.
I take your point that for the most part, people are still coming into the restaurants rather than just doing takeout.
Correct.
So then with that in mind, this isn't going to affect the number of physical stores you have, seen this kind of rise in takeout orders.
No, and in fact, we have several under construction across the country today. We continue to add new locations in underserviced markets. And at 370 today, we still see lots of places, and we have development teams for franchise sales. We are a 100% Canadian company, first and foremost, but also 100% franchise owned. So all of our 370 restaurants are owned by local franchisees. And we continue to grow either with those franchisees adding additional locations or with new people entering the Boston Pizza system and opening in places like we'll be in Revelstoke, British Columbia later this year, Dryden, Ontario, The Paw, Manitoba, and we'll continue to add new locations that way.
Boston Pizza's supply chain largely not impacted by tariffs so far. Correct me if I'm wrong, but I did hear management say that trade tensions and tariffs could be a headwind moving forward. Can you tell us where Boston Pizza sits amongst all of that?
Absolutely. So there are 2 considerations for us. One is the direct supply chain impact. So as you mentioned, we are a Canadian company founded in Edmonton in 1964, and the vast majority of our supply chain today comes from within Canada. So all of our wheat comes from 3 farms outside of Regina. All of our fresh mozzarella comes from Quebec. And so on. So we're less impacted on the supply chain side. There are some things, though, like fresh produce, which has been in the news recently, tomatoes in particular. We can't get away from that, and it does have some exposure with, with potential tariffs or import and foreign exchange and those kind of things. But it is the vast minority in our supply chain, which we're pleased about. The bigger exposure, though, for all of us in the restaurant industry and retail and Canadian businesses is just in the general consumer confidence and the disruption that comes potentially affecting employment, those kinds of things where, again, Boston Pizza is in the discretionary spending area. It's a luxury, and hopefully an affordable luxury for folks to continue to come out and eat in restaurants. And so we need to be aware of and responsive to the changes in consumer confidence and the way people are feeling about loosening their wallet or purse strings and coming out and spending money in the restaurants.
Jordan Home is the president of Boston Pizza. The race is heating up to be the Canadian headquarters of the new Defense Security and Resilience Bank. CTV's Judy Trin has more.
Global finance and advanced innovation.
Toronto launched its bid to host the new Defense and Security Resilience Bank with a glitzy video accompanied by a full-court press.
We have Team Ontario, united to support Toronto.
The new defense bank will involve 40 countries. It will hold assets of $135 billion US and employ 3,500 people.
Canada will lead the world in defense finance, period.
Vancouver, Montreal, and Ottawa are competing for the headquarters. Analysts say the winning city needs to have more than just financial expertise.
Good cultural sensibility. I think it needs to be able to communicate with different players in different countries.
Toronto has the most diverse population, but the nation's capital has the most diplomatic ties.
We're the home of 130 plus foreign missions and embassies.
But Ottawa's airport doesn't have many international flights. Not a problem for Vancouver.
We're the gateway to the Pacific. We actually are in the perfect time zone to bridge those gaps.
The bank will lend money to smaller companies in NATO nations to help them build cutting-edge technology.
The economics
and the diplomacy. So we're the only city that can give both. The economic diplomacy that this bank needs.
But Montreal could be hampered by Quebec's fall provincial election. There could be another referendum on separation, depending on who wins. Ontario's premier says he won't use it to sway the decision.
I say go Habs. You know, Montreal's great.
The federal government has yet to lay out its criteria for selecting the site of the global headquarters, but there's already a clear winner, Canada.
Judy Trin reporting there. That does it for the close. Thanks for joining us. We'll see you tomorrow.